Hey there. So in this video, we'll be talking about what is a mortgage. Now in this video, we're not going to be really doing any math. We're just defining definitions. So I believe there's no homework for this part. But we should understand what is a mortgage, how it can be attained, just relevant information like everyday life information. In your textbook, it was supposed to be a research project for you guys, but I did the research myself because you don't have much time to do research uh, in our situation. So I did all the research, and let's go across some of the definitions. Okay, so let me just look for my pencil tool. Here we go. Good. So what is a mortgage? Well, in short, it's a type of loan, and it's typically used to purchase a home, plot of land, or some other real estate. But at the end of the day, it is a loan that you get from the bank. So you're borrowing money from the bank. And mortgages are typically associated with just getting a home. So when you buy a house, that's basically a mortgage. When you get a condo, that's a when you borrow money from the bank, that's a mortgage. Obviously, there's you agree. In most cases, you agree to pay the lender over time a series of regular payments. So you pay you because the money you borrow is a lot, you can't pay it back immediately. So you have to break up into smaller payments called regular payments. And they're divided into the principal and interest. Because of course the bank will charge you interest for the money that you borrow. So not only you're paying back the money that you borrowed, you're paying interest to the bank for lending you the money. And it's based on how long you have the mortgage for. So the property then serves as collateral to secure the loan. So if you, for example, default on your payments, you're unable to make a payment, then they basically take back they take your property and all the money that you've put in thus far. So you actually lose a lot if you're unable to make that payment. So if you do, it's always best to pay things off as soon as possible because if you miss a payment, anything can happen. Life happens. And when life happens, things can go wrong. So having a long-term mortgage is not necessarily a good thing because if something happens in your life, then you can actually lose that property and the money that you've already invested into it. Where can a mortgage be obtained? Well, it can be obtained from banks or credit unions. I'm not quite sure what the difference is, but I know that credit unions are like they don't use your money for investing, but you get less interest. And banks they use your money to make more money, and they give you more interest. So that's basically the difference between the banks and the credit unions. That's something you don't really need to know, but that's where you can get your mortgage. What financial requirements must you meet to qualify for a mortgage? So when you walk into a bank, they're not going to automatically give you the money that you need. You have to prove to them that you can pay that money back and pay them interest. So you have to show them if you're making money, if you have a job, if your job makes enough money for you to pay them back. You also look at your credits, basically your history of purchases and paying off your bills. So it's basically looking at your history. And obviously, you they want some money upfront first before they give you a mortgage. So in a lot of cases, it's 5% of whatever of the property. So it's basically the down payment. So whatever your property costs, you have to pay the bank upfront 5% of what that property costs for them to even consider giving you a mortgage. And the property itself. The property it was asking if you have sufficient collateral. So is the property worth like repossessing? Okay. So how is the mortgage generally repaid? Well, typically mortgages are typically paid in regular payments with the principal and the interest payments. So not only you're paying back the amount you borrowed, you're paying a little bit extra, the interest, that's the extra part. You're paying a little bit extra for them for the convenience of them giving you the money. And so the longer that you have the longer that you borrow the money for, the more interest you're gonna be paying because the interest is dependent on the time that you borrow the money. What is the minimum down payment required for a mortgage? Now these are sort of like set rules that's set in Ontario and in Canada. If your property is $5,000 or less, You would have to show upfront 5% of this, 5% of this, in order for them to consider giving you a mortgage. So you have to come up with 5% of $50,000, so on and so forth. So the property is between these two prices, between half a million to a million. This is basically half a million, and this is close to a million. It says here you pay 5% on the first $500,000, and 10% for the portion for the anything above $50,000. So these are just conditions for getting a mortgage. And obviously, if the property you're purchasing is over a million, well, it's basically 20% of the purchasing price. So that's quite a bit of a down payment. I guess in these cases, the banks want to make sure that they're getting their money back. So, what are the advantages and disadvantages of a large down payment instead of a small down payment? Now, I'm all for large down payments because if you do a large down payment, just in general, you pay less interest because the longer you have that property, the more interest you're gonna pay. So, generally, just a rule of thumb, you get better mortgage rates. Not always, but most times you get better mortgage rates if you have a larger down payment. You reduce the interest you pay over the life of the mortgage. Because if you think about it, if you pay off most of the property, you do a huge down payment, you pay most of the property. Well, then you have fewer payments. If you have fewer payments, you have less interest. So you reduce on the interest if you have larger down payments. Lower monthly mortgage payments. That's true because again, if you pay off most of your property, because most of it's paid off, then you don't have to pay much every month just to pay off the rest. And you are not required to get a mortgage loan insurance. So that's just an additional fee. It's because the banks are a bit nervous about lending money and wondering if they're going to get paid back. So they get this sort of mortgage loan insurance, which I think it's a bogus, like, just a money scam. But yeah, that's the advantage. So you don't have to pay it. Now, in my case, I bought my property outright, just one payment. Therefore, I pay literally no interest. So again, a large down payment is always better. Now, what are the disadvantages? Well, not everybody has a large down payment. So it can be difficult to get that money. These might put aside other financial goals, so these are just minor inconveniences in the sense that it's just difficult to save that money because down payments can be quite large. It's a lot of money. So it's sometimes hard to get that money. So that's basically the disadvantage in a nutshell. I was asking what the current interest rates in Canada are. Well, I did the research here. This is the website I went to. And if you look here, a 3-year, 5-year, 3-year, 5-year, and five. Oh, sorry, 3, 5, and 5, and this one's variable. And we'll be talking about fixed rate and variable rate. In my personal opinion, I always like fixed rates above variable rates because I like consistency, and things typically go up in price. But we'll be talking more about that specifically later in this lesson. So here are the banks, and here are the interest rates. You guys can look at that. How often is the interest compounded? Well, except for a variable mortgage, in Canada, it is typically done twice per year. Now, that can change bank to bank, but it's just a general rule. It's twice per year. And I pay my property taxes about the same thing, twice per year as well. So, what is the difference between an amortization period and a term of the mortgage? The term of the mortgage is the length of the current contract. So, you get a contract, and at the end, you have to renew that contract. And the term basically affects your mortgage rate. So basically, at the end, you have a contract under specific conditions, and under when you renew it, you can change those. You can renegotiate those conditions. So, typically, short term contracts, short terms have usually lower interest rates. So that's but better. It's because the thing I would like a longer term because like I said, inflation goes up. So the when you renegotiate, you might get a worse deal, right? So that's why a lot of people like to, because typically when time goes by, typically things get more expensive in Canada and just around the world. So when you fix the rate or fix the regular payments, chances are you're getting a better deal than if you don't, depending on the state of the economy. Now, what is an amortization period? Well, it's like the term. Basically, because you're renewing the contract, that can go on for for many years. So amortization period is the total life of your mortgage. So let's say, well, this one is 20 for the maximum amount of amortization period in Canada are 25 years. So let's say your term is 5 years. Well, then 25 years divided by five, that's basically five. So that's basically 5 times that you have to renew your contract because the mortgage amortization period is the total length, and the mortgage term is a short length. And so basically, you're just dividing. Basically, the mortgage term are just a series of contracts that add up to the amortization period. So that's basically the total life of your mortgage. What are the benefits of repaying the mortgage with an accelerated payments? Well, again, if you pay off your contract faster, it's always a good thing, unless you have a prepayment penalty. Because sometimes they have a pre. Because sometimes they won't let you to pay it off early. You pay off your loan faster, and you save on the principal, perhaps thousands and thousands of dollars, and you're paying less interest because you're paying it off on a regular basis. So paying things off faster is always a better thing. Different types of mortgages. So this here is somewhat. So we have the conventional, like your typical mortgage, or the high ratio mortgage. I like to call it conventional mortgage. It's a mortgage where the mortgage loan is higher than 80% of the lending value of the property. So you're actually borrowing a little bit more than what the property is worth. Because if you think about it, you got to pay for other things such as land transfer tax, maybe some legal fees. So typically, people grab a mortgage that's a little bit slightly higher than the lending value of the property. Now, what is an open mortgage and a closed mortgage? Well, having an open mortgage, you're able to pay all or part of your mortgage at any time. So if you suddenly win the lottery and you come across a lot of money and you want to use that money, you're allowed. You're allowed to pay off your mortgage as much as you want, as often as you want. You without getting a prepayment charge. So basically, you're allowed to pay it whenever you want and as much as you want. Whereas a closed mortgage, you cannot prepay it or renegotiate, or basically you have like limitations to how you pay it. So if it's a closed mortgage, you cannot prepay, you cannot renegotiate, you cannot refinance without paying a prepaid charge. So let's say you win the lottery and you want to pay off your house. The closed mortgage will not let you pay off your house. If you do try to pay off your house, you're gonna have to pay this extra fee, which most people do not want to do. It says here fixed rate over variable rate mortgage. Again, I found that fixed rate is a lot better than variable rate because the economy changes, and maybe the economy gets better, maybe the economy gets worse. As far as I can tell, the economy always gets worse and things get more expensive. So having a fixed rate, getting your mortgage at a fixed rate at a good time is better than getting a variable mortgage because the economy can go bad at any time. And it goes bad, then your interest rates will probably get higher and you're going to be paying more. So let's read the definition here. For a fixed rate mortgage, the interest rate remains the same for the same duration of the term. That's regardless of how the economy is doing, or if you or the money that's or the your status in income. Now, variable rate mortgage has fluctuating interests. Therefore, maybe 1 year the interest rates are great. Let's say it's very low. It's like at 1%. But in the next year, the interest rates, like just in general, and the like taxes, they're like really high, and everything has gone up, including the interest rates have gone up. That means that you're paying more interest on the house that you're paying. You're paying more money. So, um, like I said, I find that fixed rate is a lot better than variable rate because in the last past couple years, things have gotten really bad in the economy. And if you got your mortgage, a fixed rate mortgage, back in 2000 or 2016, then you be paying the same sort of contract compared to a variable mortgage because, like I said, when the economy changes, the interest rate changes, and it's not necessarily a good thing. Okay, so short-term or long-term contracts or mortgages. A short-term mortgage has a term less than 3 years at a lower interest rate. A long-term mortgage has a term of 3 years or more. So basically, a short term is less than 3 years, and a long term is more than 3 years, and you get a higher interest rate. And the reason why that is because, again, the banks aren't stupid. They know that interest rates will be going up, like up in the future, right? So if you asking for a long-term mortgage, it's not in their best interest to give you a long-term mortgage because they know the interest rates are going to be changing. So they would rather give you a short-term mortgage and have you renegotiate that mortgage every 3 years opposed to 5 years or 10 years. Could you imagine paying uh, a good mortgage rate? Let's say you got a mortgage rate in 2016, and you're paying the same thing up until now. That's amazing. Okay, so I think that's about it. I don't believe there's any homework for this class, but yeah, just so you know how mortgages work.